Well, good morning, everyone, and thank you for joining the Ellerston Global and Morphic Funds webinar. My name is Lisa Rose, and I'm the Head of Intermediary Sales at Ellerston Capital. Today, we're joined by Bill Pridham, who's the Portfolio Manager for Ellerston and Morphic's Global Strategies. In today's presentation, Bill will provide an update on reporting season to date, outline key macroeconomic considerations influencing portfolio positioning, and provide an update on fund performance for January. I'm sure many of you will have questions for Bill, and we'll seek to answer as many of these as we can. If you'd like to ask a question throughout the session, you can submit this at any time. Please do so by entering your inquiry into the question section of your webinar panel located on the right-hand side of your screen. I'll now hand over to Bill to start the presentation.
Terrific. Thanks, Lisa, and thanks everyone for joining. It's always a pleasure to catch up. And it's actually great timing because we're roughly halfway through reporting season in the US and globally as well. So it's a good time for us to sit down and just to run through some of the key points we're seeing and run through some of the results that have been coming out of the portfolio. I know I always say I want to keep these short and punchy, but there's so much to go through. It's going to take probably a little bit longer than normal, but please have some patience because there's lots of interesting points here to touch on and some good updates in terms of the companies as well. So hopefully you'll enjoy it. And look forward to any questions when we're done as well. So in terms of the reporting season, like I mentioned, we were really early stage in terms of the season globally, a little bit over halfway through. Broadly positive. When I look at the US especially, earnings have been pretty solid. So revenues have beat by 3 to 4%. However, earnings, EPS has beaten on average by 19 to 20%. So you're really seeing that operating leverage we've talked about for a while now really starting to come through. A lot of companies had cut costs pretty aggressively during the COVID pandemic peak. And like we mentioned, a lot of those costs aren't coming back. And one of the drivers of that is this digital transformation that's really pulled forward into companies. And they're doing things a lot more efficiently, a lot cheaper now, and they're finding another level of cost savings opportunities, which is driving this leverage. With that said, in terms of the guidance and the outlooks, generally good, but the management are still pretty cautious. And, it makes sense when you think of the COVID waves we've seen in the US and Europe and the UK, albeit they are starting to roll over now, which we'll talk about later on. That's still a concern for them. The strange thing with the global pandemic, we went from a late stage economic cycle to early stage in like 3 months. So we're still a very early stage of this recovery. So, they want to see a bit more traction in terms of, earnings, in terms of behaviors more than anything else, because we've had some pretty seismic shifts in terms of how the world operates now. And the last point there that I put out there is supply chain bottlenecks. Not every company, but many companies are talking about this. From bike companies to auto companies to bedding companies, supply chains are very tight. And that's creating a bit of a supply limitation in terms of the growth. Longer term, that's probably elongates the cycle, and we'll touch on that a little bit later as well. We've had about 17 companies report in January and February. Similar to the market, they've performed well in terms of earnings. On an aggregate basis, they've beat revenues by about 4 to 5%. And from an earnings perspective, have beaten by a little over 30%. So pretty happy with that. And that's across the 17 that have reported. Guidance, like I said, has generally been reinstated for those that weren't. The majority of our companies already have guidance in place, but there were a couple that hadn't, and they've reinstated guidance, which has been good. The big thing we're seeing now is CapEx is. So if you remember in 2020, a lot of the companies had pulled back spending pretty aggressively to really protect the balance sheets. What we're seeing now, we're going back to normal CapEx cycle, which is pretty good when you think of the economic derivative from that over the next several quarters. Capital allocations clearly back on the table. Many companies reinstated their buybacks. Dividends are back again. So there's a lot more capital allocation opportunities around. Free cash has been great. Interestingly, there's a lot of debt refi happening now as well. So a lot of companies took down some emergency funding during the pandemic, and now they're paying that back. So the cash flow has been much better than expected. We don't need this debt, so we're paying that back. And also there's a lot of companies taking the advantage of the low rate environment to refi as well. One company that we own, Sensata, so they took down $750 million of debt during the pandemic. That's at 6.25% rate. They announced a couple of weeks ago, we're paying all that back. They got 1.8 billion in cash on their balance sheet. We don't need these emergency funding because their cash flow is so strong as well. So when you think about it, that's like $48 million of annualized interest savings from that as well. So we're seeing a lot of that come through in terms of the numbers and the go forward expectations as well. Like I mentioned, we had a very strong EPS surprise, but I got to tell you, the share price reaction has been relatively muted. 11 out of those 17, the share price was flat to down on the day. I think a lot of that has to do with the market expecting, strong upgrades come through. But I'd rather have the management be a little bit more conservative around this. So there's probably a bit of hot or fast money in there looking for fast upgrades. They get disappointed and they leave the stock. That gives us more of an opportunity at the end of the day. The business has gotten better. Earnings have gotten stronger. Cash flow has been more visible. So we've used that opportunity to add to some of our convictions. And a few of them are like PTC, which we'll talk about, Sensata and Flex. They all have been pretty solid, but I got to say, from a Sensata and Flex point of view, they're a little bit weak post results, so we added to those ones as well. So that's a bit of the summary on that. So I'm going to talk through 5 stocks, and it represents about over a quarter of the portfolio, and they've reported over the last couple of weeks. The first one's PTC. So we've been talking about them for a little bit now. So they're one of the leading computer-aided design companies globally. They are one of the leaders in product life management software as well. So that's like following your product right from the design phase, right through production, right through into the field to see how it's operating. So it's gone through a real transition in terms of the business model from a licensed business to subscription, which is highly recurring and incredibly better from a margin perspective as well. So over the last 2 years, they've added 10% to their margins. So gone from 20, and this year they'll be about 30% EBIT margins. We'll get more margin accretion going forward as well. So it's been a massive shift in the operating dynamic of the P&L, and that's coming through in the numbers. So they reported Q1 revenue. Their September year-end company. They reported revenue up over 20%. EBIT's going to be up over almost 65%, which is pretty nice to see. The market was a little bit circumspect in terms of what they're hearing from the COVID wave and all that, but the numbers came through pretty solidly. The more pleasing aspect was their guidance. So they guided to 17% growth for the year and over 20% growth in EBIT for the year as well. To put that into perspective, they had previously guided midpoint 8% for revenues and about 7% for earnings. So they're seeing some really strong activity levels in their business, and the leverage is really showing through in terms of the numbers as well. If you look at the bottom there, industrial companies are really looking to right-size their business. Looking how do we do this more efficiently. PTC is the leader in factory automation in terms of smart factories. So if you want your gearbox to talk to your computer-aided design specs, these guys provide that. And we're seeing a lot of companies talk about this, from John Deere to Bosch to Saab. I believe we're in a massive upgrade cycle in terms of this factory, it's a smart factory, because you can take hundreds of billions of costs out of the entire ecosystem from that. Moving on to Sensata, which I touched on that briefly earlier. So the big thing with Sensata, they're one of the main players in sensors globally. So tire pressure sensors, emission sensors, many different applications for these sensors. And the world is moving to a carbon neutral goal. And I feel like you need to measure to get to that mandate. And you need these sensors in field and all the assets to see where you are. And Sensata is clearly a leader in that space. The issue that Sensata had last year was the majority of the business, over 60%, is levered to automotive. Automotive, as we all know, was severely impacted by the COVID pandemic. Globally, it was down over 20%. They had performed quite well compared to that. So their revenues came down around 12%. And the reason for that is content per vehicle. I talked about these sensors. Sensors per vehicle or content per vehicle is going up. And so they're outperforming their end markets by 4 to 6% in the automotive. The other part of the business is heavy vehicle off-road. They outperform by 6 to 8% in terms of the end markets. So when you think about it, so we've had a really dramatic downturn last year. Now we're going to see an uptick in terms of end markets, and they're going to outgrow that by 4 to 7% across the board. So they've already guided for the year to 16 to 18% growth from revenues. Earnings are going to be up 30%. But if you remember, I talked about paying down that debt. EPS is going to be up close to 50% on the back of the lower interest costs coming through as well. The thing I really like about Sensata is the EV angle in the business. So they're one of the leaders in the space. And the best part, the market had been concerned as you transition from internal combustion engines to EV, do they get the same content per car or does it go backwards? What they're seeing, it actually increases by 20%. There's a lot more mission critical sensors required in an electric vehicle. And they are one of the leaders in the space. And I love the quote from the last call. They're basically in all OEMs who's announced an EV or have a design out there. And I believe that they will get a strong tailwind from the EV adoption that we'll see over the next several years. The business trades like a little over 14 times with that driver behind them. So I think it's in a really good spot now from one of those early stage recovery businesses in a strong end market as well. Flex we've talked about in the past. Flex it's very levered to the industrial economy. So anything from, communications, which is like, they develop or they build, 5G applications. They build 5G infrastructure requirements. They build a lot of industrial applications. They build a lot in automotive, EVs. They build a lot in healthcare. You think of drug delivery systems or monitoring systems, they'll build that as well. They also do a lot in consumer electronics, which has really been strong for them. So laptops and computers, you name it, they'll assemble that as well. The big part of the business, or the most exciting part of the business to me, is their Next Tracker, which is effectively the largest solar tracking business globally. It's held inside the group, and management on the last call were very focused on addressing concerns, or not concerns, but expectations of them doing something with that asset. We've had a couple IPOs, which is really highlighting the underlying value of the Next Tracker business, and they're looking at doing something there from a spin or an IPO from that. Now that's great, and I think that's worth like over $7 per share. It's a $19 stock today. But underlying that, the core business is performing very well. So Q3 revenues is starting to return to growth. The last few quarters have been negative because of the end markets have been under stress from the COVID pandemic. But now we're starting to grow, and the leverage is very strong. So we had earnings up over around 20% this past quarter. Despite the supply chain and the bottlenecks, they expect earnings to be up even further in the next quarter, mid-20s. And then we're going to cycle some really weak periods over the next couple quarters. So you can see some strong quarterly growth for the business with the opportunity for them to really extract value with this Next Tracker IPO or spinoff, whichever is the most shareholder-friendly way. And we'll be interested to see how they do that. One thing that's interesting with Flex as well from an ESG point of view, they just raised a bond, a $2 billion bond, refinanced a big part of their debt, and that's linked to ESG initiatives. So it's linked to the greenhouse gas emissions. They'll actually get interest savings if they can exceed some of these metrics out there. So they're really taking this seriously, and they're putting their money where the mouth is. We're going to raise this bond on the back of ESG initiatives, and we'll benefit from it as we outperform those KPIs, which is great. Option Care Health, there was a great question on the last call, Option Care being a new entrant, and what are they? They're performing quite well. And just to recap, they are the largest independent provider of home infusion. They cover over 95% of the U.S. population. What I'm finding is at-home care is disrupting hospitals. And it makes sense. Hospitals are incredibly necessary, but to heal properly at a low cost to the system, at-home care done properly is really a great way to go. And these guys are the leader in the home infusion. So let's say you're in the hospital, you come out and you still need anti-inflammatory or anti-infection infusions. They come to your house and provide that for you. You don't have to go back to the hospital to get that done. And that's a big patient benefit. It really does good, and I like that. There's just out of hospital, there's also chronic issues, muscular dystrophy, Crohn's. If you have to have somebody come, if you had to go to the hospital and get an infusion, you run the risk of infections. It's a logistical problem, timing perspective. They come to your home and do it for you. And the beauty is, from a cost perspective, it's like 40, 50% cheaper than a hospital setting. So it's a win-win. The patient likes it better because it's convenience, and the risk of infection is very low. And the payers like it as well because the cost of it is so much lower as well. So it's a real strong dynamic in terms of doing good and taking costs out of a system which is as we all know, very overrun in terms of the cost structure in the U.S. So they pre-announced their Q4 numbers. They had guided to 216 to 220 million of EBITDA. They're going to come in around 222, so above the high end of their guidance, which is good. But the more important thing to take away is their run rate on margins now around 3% higher than when they entered this year. So in 1 year, they've added 300 basis points to their margin profile. That's going to drive next year numbers pretty strongly as well. The business is benefiting from a large addressable market, over 100 billion of infusion services in the U.S. Only 14 billion of that is at home now. We feel that transition, that shift will continue. So you should see high single digit to low double digit revenue growth for the foreseeable future. Their model is to grow earnings at least 2 times that. So you have a business growing at 20% plus on the back of that. The reason for some of the weakness through the year has been private equity sell downs. So Madison Dearborn had owned 80% of the business at the start. They sold a portion of the shares at $12.50 in July last year. That was our entry point when we saw that happen. We got in on that sell down. They did another one at $15, and their last one, which was 2 weeks ago, was $18.50. The stock's over $19 and absorbing these sell downs very efficiently now. So you can see how a private equity sell down we like, because when you think about it, as they sell down, as long as the business is performing well, which this one is, as they sell down, you get more liquidity in the stock, and secondly, that PE overhang goes away, so you get a double benefit from that. Even with the share price going from $12.50 to over $19 today, it's on 13 times next year's EBITDA, growing at over 20%. And I like to compare it to a Medicis, which we've owned in the past. A Medicis is at home care as well. A Medicis trades at just under 30 times. So this stock is trading at a 15-point discount to what I believe is one of their better comps. So I can see the business really continue to grow from a just operationally point of view and from a multiple re-rating point of view over time as well. Now, I don't want anybody to roll their eyes. I know I talk about Jennifer Seeley quite a bit, but it just keeps on delivering. For a betting company, you think, how much growth can a betting company deliver? But as the world's largest betting provider, it's really, it's accelerating. They grew FY20 revenues by over 18%, earnings by over 50%. Now, the question that I had with that, and there were questions on the last call about pull forward. Now, I was concerned about the pull forward as well. They really benefited from at-home spending. You can't travel anywhere, so let's have a good night's sleep, effectively. And that really showed up. You think about a business that grew earnings over 50% in the COVID environment, and it's pretty good. But, they guided last week, and they guided to 15 to 20% revenue growth. The market was like at 2. So it's a massive upgrade from that perspective, and earnings up over 20% as well. You think, how can they continue to grow at that level? Well, actually, this year is not even going to have much Europe contribution. They said that's more of a next year thing because Europe was still in lockdown. Distribution channels, which they had won a lot of market share, took time to open up this year. So that's going to be more of a this year and next year opportunity as well. They got new SKUs coming up in Sealy. And secondly, on a supply chain, they just couldn't keep up with demand. Sealy manufacturing, which is more physical than Tempur-Pedic, had a lot of bottlenecks, and they could not keep up with the Sealy demand. So they see that really coming through over the next couple of years as well. So this business, trades on 12 times PE, trades at 8 times EBITDA. They'll generate about $600 million of free cash this year on a $6.7 billion market cap company. They reinstated the buyback. They're going to double it, though. They were going to buy about 3% of the company. Now they're going to buy 6% of it back. They put in their inaugural dividend as well. So we talked about the capital allocation decisions, and Tempur Sealy is a poster child for that because they're doing the buyback plus a dividend, and they're looking at different opportunities in terms of returning capital as well because their balance sheet's becoming relatively ungeared given the cash flow that they're delivering. And at that type of multiple, I still, even though it's had a good run, still see some really strong upside for the business as well. So it's a bit of a rundown in terms of some of the stocks that have announced over the last couple of weeks. Like I mentioned, we're roughly halfway through. We'll touch on a few more later on. But what I want to do as well is talk about how we're seeing the landscape. So we've had 2 seismic shifts this year when you think about it. We had the COVID pandemic, which really changed behaviors. we're still working our way through this. We really don't know what the next step is, but things are opening up, which is good. But think of the e-commerce, you think of digital, you think of the way people travel, the way they consume it. It really has changed. So you need to take that into consideration, and we are. The second one was the U.S. elections. With President Biden now, driving the train over there. Effectively, things are going to change and have changed. The big thing now you see about the pen strokes, he's been pretty active in terms of putting new initiatives in place, and we'll talk about them as well. So with that, let's run through these considerations. So like I mentioned, we've seen a political inflection in the U.S. So the Democrats effectively control both the Senate and the House now, and with that, it gives the Democrats a bit more power in terms of getting things through. And the big one that they want to get through right now is this fiscal stimulus. So we've had two pushes in terms of stimulus into the markets. And if you look at the chart there to the right, the bar chart, you can see the blue is effectively people losing their jobs and people losing income, what's been taken out of the system. And the yellowish, whatever color you want to call it, the yellowish is basically what's been put back in by the government in terms of transfer payments. And it's actually more than what's been lost. And that's been saved effectively. So what the Democrats want to do, though, is get the next fiscal stimulus package through. They're talking $1.9 trillion, another $1,400 per person check to be sent out. There'll be another initiatives which we'll talk about in terms of the Build Back Better. But does he get $1.9 trillion through? I don't know. But I do believe it'll be a big number at the end of the day. He really wants to get something done. That was part of his mandate to get elected, and he wants to show he's proving through in terms of his promises from that perspective. All we're going to talk about here will drive higher growth and higher inflation at the end of the day. So we have the stimulus. This Build Back Better. If you get a chance, go and watch his presentation on this. It's pretty powerful in terms of him wanting to not transform, but to really re-energize the U.S. manufacturing sector. So he's actually put in place a director of Made in America. So he's very firm on this. So he wants to drive domestic manufacturing. He wants to drive domestic jobs. He views this as one of the bigger spending initiatives since World War II. Massive spending on infrastructure, bridges, ports, you name it, and clean energy, green energy as well. So he really wants to focus on that. He talks about Fed procurement, $600 billion spent in the federal government. How can we make sure that's done more efficiently and more tied to domestic companies as well, small, medium enterprises? So, there's going to be a big spending initiative from a fiscal paychecks and from spending activity levels as well. And we're already seeing that come through in terms of the numbers, in terms of the household net worth, especially from the stimulus packages we've seen to date. Now, what we're hearing, though, and you've seen this through some of the companies we talked through, there's a lot of pent-up demand out there as well. So we've had all these stimulus checks come in, yet we can't really get out and spend it, So we've been in a lockdown, and the saving rates have gone through the roof globally. And now we're getting to a period now where the COVID cases are starting to peel over. Hospitalizations are really dropping. So we're going to see a period now where, those headline risks around COVID waves probably go away for now. Clearly, we're getting different derivatives of the COVID virus. Can't call what happens that longer term, but we've got 9 vaccines in the market today, and from what I'm understanding is that the platform in place is very flexible. So if there's a new strain, they can relatively quickly come up with a new vaccine to address that. So we'll wait and see how that works. But at the end of the day, we're seeing the COVID cases come over. We talked about the excess savings in the system, and Morgan Stanley estimates over $2 trillion. That includes this next stimulus to come through. So $2 trillion of excess savings in the market. We got the government really wanted to push fiscal. We really want to drive infrastructure spending. We really want to drive domestic manufacturing. And you couple all that together with supply chains are tight. If you look at some of the names here, like from bikes to semiconductors to smartphones, we're seeing across the board a level of inventories which are at record lows. Autos, you just cannot keep up with the demand from an auto production point of view. It actually makes sense when you think about it. Like the world effectively shut down in March, April. And now, as a supplier, I'm waiting for him to start up, so he starts up. So I've been waiting for him, so then I can start up. down the chain, they're all waiting. So there's cascading domino effect of delays in the supply chain. Now, I think that'll work its way through. Tempur Sealy said probably by second half, they'll start to get through all this and it'll catch up. They'll get to more of an equilibrium. But in the meantime, we're going to see price pressure come through, and we're seeing that now. It's coming through in terms of the goods that are in demand. So we have different areas where you think of healthcare or effectively retail and leisure. You still got muted inflation, but goods that are in demand, we're seeing inflation pick up. You look at house prices, you look at cars, you name it, used cars especially. It's really driving price inflation in those areas. So the big thing to watch for is how that really translates through in terms of the economies, and is the supply chain flexible enough to offset that over a medium-term basis. But couple that with this fiscal stimulus, we're going to see some higher inflation on the back of this, based on demand-driven. So, which is good. That's actually quite healthy, but we need that supply chain pick up to really offset that inflation that's coming through today. Like I mentioned earlier, we've gone from a late cycle growth economy globally to early stage growth in a few months. So this year, the GDP in the U.S. is expected to be down 3.5%, and the Eurozone down almost 7%. Consensus has U.S. growing at a little over 4% next year. But I think you're going to see a wave of upgrades to that, and we're already seeing it now with Morgan Stanley, UBS. They're all 6 to 7% growth this year, baking in that next stimulus package to come through. And if you look on the right-hand chart there, we see the business price index versus the urban consumer price, the CPI, effectively. You got to think that light blue line's got to follow that up a bit. And what works in that environment? What works in a generally inflationary, higher growth, higher inflation environment? That's your cyclicals, financials, not as much your big cap tech, not as much as your momentum stocks. I'm not saying they go down, but they probably mark time or perform relatively lower than those cyclicals and value stocks. And that's how we've been positioning over the last several months as well. So with that, we'll switch to the barbell, which I hope everybody's used to seeing now. Like I mentioned, I think I mentioned last call or the call before, if we were to flip this around 12 to 18 months ago, it would have been equal and opposite on the other side in terms of growth versus value. So as I mentioned, we've been moving, basically since September, we've been moving more into that value side of angle. And that's, by value, I mean like cyclicals and industrials. So your regional banks. So we added 3 regional banks, Webster and Comerica and Bank United. We've been adding more to industrial companies, such as XPO. We've been adding more to Keon, which is one of the largest factory automation and forklift truck businesses globally as well. So we've been adding a lot more to those types of businesses, which will benefit from the cyclical growth that we expect. Ones that can offset inflation as well. They got good pricing power, which is very important in this environment. And if you flip to the right-hand side of the barbell, the growth companies there, it's interesting, their growth, but they still benefit from what's happening today from a cyclical perspective. PTC is based on industrial activity. It's making that industrial activity smarter, but at the end of the day, it's all about the PMI for them. Sensata, when you think about it, automotive market, heavy vehicle off-road market, so they're heavy industrial from that sense as well. So you have a number of companies that are digitally addressing a market, but have an underlying driver, which is more on the industrial side of things. And I'm always had trouble saying what's value versus growth. If you look at XPO Logistics, they had the results last week, and they're forecasting over 25% growth for next year as a trucking company. So that's pretty growthy to me, but I kind of put it in the value bucket because that's typically where it has been, and it benefits physically. So e-commerce driving consumption at home, they provide that LTL or last mile trucking aspect to it as well. So they really benefit from that. So that's where the portfolio is there. Not a lot of name changes, adding more to existing positions. A couple new ones in there that we talked about previously, but at the end of the day, it's very much around that cyclical industrial aspect to it. The world's changing pretty quickly, and we'll be very adaptive to it as well. We're not going to just say, hey, this is it. This is the portfolio for good. If things change and we feel we need to adjust the weightings around this, we can do it pretty quickly. And we've shown that we've done it in the past and we'll continue to do it as well. We're very focused on that. One thing we do like to do is let the companies tell us what's happening. And we have calls with them. Right now we're going through the results. So we're getting affirmation of those past calls. If you remember on our last call, I ran through all the calls we had. And the nice thing is that they're coming through in terms of what they had indicated in terms of results. So that's pleasing from that side of things. Now, a couple of companies I haven't touched on, they do have had results, but I wanted to, as investors, we all, I want us all to understand what we own. We talk about some of the main drivers and some of the main businesses, but I want to also talk about some of the smaller positions that we have that are growing in importance. And talking about, one of the things we want to do is to invest in companies that are really making a difference at the end of the day. One of them is MIPS. It's basically what it does. It's structurally engineered into bicycle helmets, anything with a helmet, effectively. So it could be bike helmets, motocross, ski helmets, you name it. But right now, the biggest market is bicycle helmets. So next time you're walking down the street and you see a bike rider go by, have a look at the back of their helmet, right in the back corner, and hopefully you'll see a little yellow dot, and that's MIPS. So what they are, it's incredible IP built right into your helmet, and it basically mimics the brain fluid and helps with concussions. It helps reduce a lot of brain injuries. I had 4 young people outside the house last weekend stopped, and they all had the MIPS on the back of their helmet. So I asked them what it was, and the quote was, "It's like a roll cage for your brain." And I loved it because that's exactly what it is. So the business is performing quite well. They had the results last week. They reported just under 80% organic growth. They're doing over 50% EBIT margin as well. This past year, they have sold over 7 million helmets out of 130 million addressable opportunity. They're basically in all the big brands. Now it's more about the penetration per brand, getting more models with the MIPS integrated with it. And I think over time, people are aware of it now, but I think over time people will expect it as a safety measure. That's a really good business, doing a lot of good, protecting our, you and me and the kids in terms of injuries at the end of the day. The other one there in the middle is AZEK. So they're a large composite decking business in the U.S. They're about recycling plastics and waste plastics into decking. They're talking on the last call. They had guided to, last year they did 400 million pounds of plastics out of the system, which would normally go to a landfill. Now they're saying we want to get to 1 billion by 2026. They're taking a lot of pressure off landfills and recycling that back into product, which is great from that perspective. They reported their numbers last week as well. They upgraded earnings to 14 to 18% growth for the year. They were at 10 to 14, and they'll do low 20% earnings growth as well. So they're really benefiting from the decking environment in the U.S. and the spending at home as well. The last one on the right there I wanted to talk about was SIG Comblock. We haven't talked about it a lot in the past, but I really like it because it's all about aseptic packaging. So there's 2 players in the world, Tetra Pak and SIG. So when you're in the supermarket next time, go down the aisles and you'll pick up a pack of long life milk, and it could be Tetra Pak or it could be SIG. So SIG bought Visi last year. So they're more in that almond milks in your organics side of things as well. So that you look at them and you'll see them on your local shelf. What I like about it is they're really focused on reducing the use of PET globally. PET, as we all know, has a very long shelf life in the environment. And what SIG are doing is really developing products which can replace it and doing it in a really economically and environmentally friendly way. So as this slide shows, the world's first aseptic packaging pack, which is clear line of sight to 100% renewables, which I think is fantastic from that perspective. They're winning awards on the back of that, and they're actually replacing a lot of, when you think of mineral waters and the waters and anything out there that by looking at from an environment point of view, they're actually replacing a lot of the plastic. Costs a little bit more, but the consumer and the companies are willing to do that because it really helps with their carbon neutrality. Those are 3 businesses which I wanted to kind of highlight as well from a portfolio perspective. Us all as investors, we own these, and I want to make sure everybody's aware of them in terms of the portfolio. Now we'll quickly touch on the performance side of things. So with the Ellerston Global Mid-Small Cap Performance, we're very happy with the numbers that we're putting out. And the other aspect as well, like we're investing in some really strong global companies, and with that, you can actually create some great returns while investing in businesses which are making differences as well. So when you look at the performance over 6, 12 months, and I like more longer term. I like look at 3-year plus, and through that we've been holding up quite well. Well, knock on wood that it continues. But I think if you buy great businesses and back your conviction around those businesses, it should show up in the numbers at the end of the day. And that's similar with the Morphic Global Opportunities Fund. If you remember, we had the announcement out in October that I assumed a role as portfolio manager for the Morphic funds. So this is a Morphic Global Fund, the numbers there, which when you think about how I'm managing them now, it's going to be mirrors effectively. They're all going to have predominantly the same businesses in them. Like there won't be much difference between them. I want to manage them as mirrors of each other. At the end of the day, they all have that same drivers behind them. So when I'm talking about one fund, I'm talking about the other fund as well. And that's the same with MEC, Morphic Ethical Fund, which is a listed company. It's actually managed exactly the same as the Morphic Global Opportunities Fund. The performance has been very similar between the two of them as well, and you saw that in the last newsletter. So, we talked about the positioning in that. Actually, Sensata was one of the companies of focus in that last newsletter. But one thing we have done a little bit differently in light of the performance of the fund, what we wanted to highlight was the profit reserve in the fund, and that has gone to around 23.5 cents, 23.6 cents to be exact, in terms of a dividend profit reserve in place. So we'll provide that monthly. That's at the end of January, that number. So performance has been pretty solid early stage in February, so hopefully that'll show up in that number as well. But when you compare that to a share price of $1.08.5, that's actually quite a lot of dividend reserves in place. So the takeaway here is that the funds are being managed basically mirrors of each other. I want to do that from a simplicity standpoint for myself, but also be able to talk to you in a very succinct manner from that perspective as well. So with that, Lisa, how about we jump to some Q&A?
Thanks, Bill. As usual, some great questions are coming through. The first one for you is about Tempur Sealy. The participant is asking, do they sell online? And if so, what percentage of sales come through via this channel?
Yeah, that's a great question because that's one of their big focuses now, omni-channel. Every retailer globally is really focused on omni-channel, which basically means we got to make sure we're doing good digitally and bricks and mortar. So yeah, Tempur Sealy, they do have online. So I think in the last call, they said roughly, I'm going to say roughly a third of the business is online, and that's through their own website as well as third-party websites. So they have a big distribution agreement with like a mattress firm in the U.S. So what they say, third-party websites and their own, they have that digital sales capability, which they're really focused on growing as well. That said, from a bed perspective, they say I think it's like 80 to 90% of the initial thought process is online, and then I go to the store for that last touch and transact in store. And on the back of that, they have their own Tempur-Pedic branded stores. And they said on the last call, if that was split out as a business on its own, it would be a top 5 bedding retailer in the U.S. It's over $500 million of revenues, growing at double-digit rates. So great question. Yes, they do have a good digital strategy in place, but they also have the bricks and mortar. They're really focused on this online, more of an education side of things, but a good part of the business is online as well.
Thanks, Bill. Another one for Tempur Sealy. You mentioned global supply chain earlier. Keen for more colour around your thoughts there.
Yeah. Again, so on the Tempur Sealy side, it's basically to do with the inner spring, the steel, the springs. They're having trouble with that, and that's mainly with Sealy. They figure by the second half they should be through that, which is important when you think about it. Last year they grew 18% revenue, and that was with that supply chain bottleneck in place. That won't get rectified till second half, so they've got 15 to 20 for the year. And these guys, they're pretty conservative, the management. So if they say 15 to 20, they'll probably shoot down the middle of the fairway on that. So we've got next year to benefit from the second half loosening of the supply chain for Tempur Sealy. They said Europe's going to be very flat this year, so that's more of a next year story as well. But broader question on supply chain, I think it's a great point around what it means. So a lot of the companies are being very conservative, and that was my initial slide. The management are very aware of supply chain issues, and they're being conservative around what they're saying from a from a growth point of view because they know there are these bottlenecks out there. What we're hearing consistently, though, second half forward should see them being addressed. Chips are one of the bigger ones in terms of supply chain issues. It takes time for foundries to ramp up, and that's a 6-month issue. Once they ramp up, though, we'll see the activity levels pick up, and activity levels should pick up as well. So glass half full, I'm looking at it saying, look, we're already providing this growth with the limitation on our supply chain. What happens when things start to pick up, in terms of supply chain and ability to serve when you have this liquidity in the system as well? So you could see a couple things. One, second half going forward, you could see surprises on the upside potentially. But my gut feel is that we'll see this cycle elongate a little bit. You think of the autos, you think of, we touched on a few of them there, even bikes, we're going to see this cycle elongate because supply chain's holding things back now. It's not a demand issue. Demand's very strong. It's a supply issue. And once that resolves itself, I think you'll see things start to even accelerate over the medium term from there.
Thanks, Bill. Next question for you. In a previous webinar, you mentioned the emergence of opportunities outside the US. Are you still identifying attractive new ideas?
Yeah, MIPS is one of them. So MIPS was a recent business we bought. They're based in Sweden. So that is one. I got to say, though, from a new positioning point of view, not as much. So if you remember, we talked about buying a group of SEB. We bought Bureau Veritas. We bought Keon through that pandemic period. So we're able to take advantage of those companies. So brand new ones, not as much. MIPS would be the only one that we've added recently in Europe. Just more than happy to own what we've got now. We'll continue to look for new ones, but very happy with the existing portfolio of European stocks we have in there. One call out on SEB, they actually provided Q4 guidance or Q4 results as well. They said that the full year was going to be down around 6% from a revenue point of view. It's going to be down around 4%. They had said that earnings are going to be down 25 to 30%. Now they're going to be down around 14 to 15, so about a 10% upgrade there. We've had some great questions around pull forward on that one. It's not pull forward yet. We're still cycling some weak numbers, but you can see the business really starting now to cycle that. So it's actually performing quite well. But no real new ones outside of MIPS, Lisa.
Perfect, Bill. I've got another question for you, but I might just remind participants you can ask a question at any time. We don't have any additional ones after this one, Bill, but it is, what is your current cash holding?
Oh, great question. So current cash holding is about 8%. Now, I will tell you that it was in the low double digits a couple of weeks ago. And the reason I've deployed more capital recently is I talked about some of the results that have come out. Sensata is a great example. Flex is a great example where the share price was down on the day despite a very strong result, and I added to those positions. So I deployed more money into existing positions post results, which were incredibly strong, yet the share prices didn't reflect it. So it's in that high single digit level right now.
Thanks, Bill. I might just give participants one final chance to submit any additional questions. And while we do so, Bill, any kind of closing comments you'd like to share?
Sure, thanks, Lisa. And look, I always like to thank everybody for taking the time. I know it's a long time to take out of your day to listen to me rabbit on, but I do appreciate it. One thing, a couple of big takeaways I would like you to have is we're very focused on our positions. I think you can pull that away from the calls we've had previously and the discussion we have now. There's a lot we always need to run through, so I tend to go pretty quickly. So if everybody needs more follow-ups, I'm more than happy to do that as well. We're pretty excited about positions. They've had a good run, don't get me wrong, but Tempur Sealy is a great example. Like, it was getting closer to fair value, then it upgrades by 20%. So you can see more upside coming through. So my point around that is you buy great businesses with great thematics behind them. They tend to surprise on the upside, and they tend to provide that long-term compounding benefit to us all the shareholders. So those are the key takeaways from today.
Well, thank you, Bill, and thank you to all our participants who have dialed in today. We're going to leave questions there. I trust you all found today's session useful, and a recording of the session and the slides that Bill spoke to will be sent through to everyone shortly. If there's anything further needed post-session, please don't hesitate to contact a member of the Ellerston distribution team directly, as we're more than happy to help with any matters as required. Thank you all again for attending, and I trust you have a good rest of your day.
Great, thanks so much.